I want to shift over, though, to the broader market and bring on our next guest, and particularly kind of digging into the fact that we've seen a pretty solid slate of newer highs here. Not today, as the market pulls back just slightly. You see the S&P 500 off by about 0.25%. But what could maybe that break from all-time highs and closing days for the S&P 500? What could it be signaling? For more on that, I want to bring on Dana Dioria. Envestnet PMC Co-CIO joins us right now. And Dana, good to be chatting with you again. I mean, your notes are kind of walking through how many highs we've hit here on the year so far and likening it back to other, I guess, bouts of volatility. But talk to me about what today's action might be signaling about maybe a leveling out of a break from those all-time highs.
Yeah, thanks for having me. Certainly we can't expect to hit. It seems like that lately. Chatter about a 5% correction, definitely increasing of late, and I don't think anybody should be surprised if that happens. I certainly don't think too, when you consider what's going on in Washington right now and the policy that's being debated and what's going to happen over the course of September, the potential tax increases, what's happening with the debt ceiling. It's really kind of interesting, I think, more that markets keep hitting these highs and then we're not seeing more in the way of pullbacks.
So does that mean you're a little skeptical of that pullback when we talk about the chatter that's out there? And if you, in fact, think that there is going to be some kind of correction, how do you think investors should be positioning themselves? We had a guest on earlier who said it is still about value over growth. Where do you stand on that debate?
Yeah, I definitely tend toward a value bias, just generally speaking. I think valuations are, I look at academic evidence on how to approach markets, and valuations are one of the few indicators that really have efficacy, but it's midterm efficacy, right? It's not what's going to happen tomorrow. It's how to position myself over the course of a longer strategic, a cycle, right? So certainly a tilt toward value, I think, is still works, right? It's something that you should be looking at doing. As far as what's happening right now, I just think September being crowded with a number of policy considerations, tax hikes that could knock, on the order of 6% off of S&P earnings growth next year. These things are ultimately going to be priced in. I don't think they're priced in yet from the economic evidence that we see. So at what point does that finally start happening? I think, of course, you're going to see a correction at that stage of the game.
Yeah, and that's, I guess, kind of the problem there is, you had all these models factoring in continued growth in this recovery, and now coming off of it and noted consumer weakness there is a lot to factor in. But I guess maybe some of that might be focused here on the U.S. Your notes make a point of emphasis is to look at emerging markets and how maybe the balance there has been shifting more so towards Asian countries. Talk to me about the opportunity you see there in EMs right now.
Yeah, so of course, the discussion on emerging markets right now is all about China. That's where the focus is. And we get some very different opinions on whether you should be very concerned about what the Chinese government is doing and the continued crackdown, or this is a buying opportunity and you should kind of go into China heavy. Certainly, if you're in emerging markets from a strategic asset allocation perspective, you probably have a pretty heavy weight to China within that index. And even without China, it's shifted a lot more to tech than it had in the past. So that's something to be aware of. But I think if you're negotiating how do you approach emerging and how do you approach China within emerging, you might need to think about maybe a cap. You might want to think about how much you have pointed towards China, now and ongoing, right?
I mean, particularly on China tech, the argument has always been, despite concerns about regulation, any government action, the growth story remains intact, that there is long-term a higher return. Do you think that case has come increasingly into question on the back of the most recent action we've seen taken by regulators over in the country?
I do. And I do think there are plenty of people who are taking a step back and saying, whoa, maybe the protections as an investor that I'm accustomed to in the US that I sort of took on faith, I could expect, in other nations that are not necessarily the case. On the other hand, I do think, as I said, there's going to be a group of active managers and investors who are going to see this as a potential buying opportunity and who are seeing it that way. And we're starting to see now a lot of the policy filter in. So we're getting a sense of where this is going to come out. So certainly investors are now pricing that in as well. My overall on this is that you don't want to leave China. China's a huge piece of the global economy. You just need to watch, what is my weight to China? Am I well diversified? Am I hedging my bets, so to speak?
Yeah, diversification always key in so many cases, certainly no exception with China too. Dana Dioria, Envestnet PMC Co-CIO. It's good to talk to you today. Really appreciate it.